Welcome back to the Inner Circle Show. In today's episode, we have Morgan Stanley making a very bullish stance on Tesla, and also Piper Sandler coming out with some bullish commentary as well. And we have new information about the Tesla Cybertruck. But before we get into all of that, don't forget to like this video, subscribe to the channel, and turn your notifications on so you do not miss an upload Monday through Friday. So if you're someone that checks Tesla stock regularly, which I will admit I do as well, even though I don't really see the point of checking it every single day, because ultimately I'm a long-term investor. I'm here for many, many years, and actually checking it each and every day has very, very little point. However, it doesn't stop me. It doesn't stop me at all. I'm not someone that actually checks my portfolio very often, but what I find I do is I just somehow end up with my phone in my hand on, Tesla stock online. It's kind of like a tick that I must scratch. I don't really know. Anyway, enough about my problems. I'm someone that looks at Tesla stock, and if you are as well, you would have noticed that yesterday was actually a pretty good day. I think we ended the day up by over 5%. So, like I always like to do on this channel, even though again it's not as important if you're a long-term investor, I like to unpick why that is. Because I think if you understand what moves the stock, you are better placed to actually be able to control your mindset and control your emotions when the stock moves. Because if you studied it and you see that time and time again Tesla stock moves because of false information, mass media lying about Tesla, when that happens in the future, you can actually take that as an opportunity rather than freak out and start panic selling. So I think there are two main reasons as to why Tesla went up by quite a substantial amount yesterday alone. And the first one comes from Morgan Stanley. They have actually said that Tesla is now their top pick. But let's look deeper. So I saw this on X posted by Sawyer Merritt, and we're going to take a look at what the actual Morgan Stanley note said. But I did notice that Elon saw this as well and just replied with cool, which made me laugh. Straight to the point there. Anyway, so the news is that Tesla is now Morgan Stanley's top pick. With 40% upside to our $310 target, more managed expectations on autos and powerful emerging drivers of firm value, we make Tesla our new top pick in US autos, replacing Ford. Here's the full note. So that makes me think that before this, they had Ford as their top pick in US autos, as a US auto company. Replaced, and now Tesla has replaced Ford. Fair enough. I think that Tesla should sit above Ford, but even so, I don't really think that that's the right way to view it. I don't think that Tesla is the top pick for US autos. I think Tesla is one of the top picks for artificial intelligence, robotics, a technology company, a tech pick, all of these things. But let's just actually read this full note here. So we just read that bit. We highlight a number of reasons why we make our new top pick in US autos. The first one is cost cutting and restructuring has stemmed the downside risk to the EV business. Tesla's Q2 results came within 3 or 4% of consensus expectations and ahead of our own, when stripping out reconstructing charges and regulatory credits. Quite a lot of people were not very happy about how much came from regulatory credits. Let me know what you think about that in the comments below. The over $0.6 billion of restructuring charges recognized by Tesla in the quarter, combined with other actions, has helped lower the break-even point to levels where Tesla can still generate positive cash flow at an enterprise level, even with EV capacity utilization at 69% last quarter. While Tesla is still making cars, we note that the company is aggressively redeploying incremental resources, technology, people, and capital away from the auto side of the house. I'm glad that they've said that very quickly, because that is exactly what's happening. We are seeing a shift take place. We found it notable that Ford management spent far more time on its Q2 conference call discussing EVs than Tesla did. Yeah, that's because Elon and the Tesla team very, very, very much know that this is all going to be very insignificant in years to come. They are moving away from their revenue coming from autos. So why would they spend so much time talking about it? Obviously, Tesla has been built on selling EVs, but this was always their plan. If you look back at the master plan 1, 2, 3, whatever, you'll see that they always wanted to start off with a higher end car to raise capital. Then they wanted to move through and make a mass affordable vehicle, which we're going to see very soon, I think. And then they wanted to make an autonomous vehicle. And now they're leading that into robotics. So yeah, let's carry on here. Cornering the market on zero-emission vehicle credits. Tesla recognized zero-emission vehicle credit revenue equating to around $2,000 per unit in the quarter, more than 2 times the recent run rate. We believe as more legacy OEMs pull back on their EV plans, combined with increasingly stringent EPA standards, that Tesla may achieve an even more dominant position in the market for highly lucrative ZEV, that stands for Zero Emission Vehicle Credits, going forward. Yeah, and then you have to tie this into what could happen in November in terms of the election. If it's a Trump presidency, this could obviously shift things up as well, and that can play into it. I don't think that's going to negatively impact Tesla whatsoever. I think it's very positively going to impact Tesla, as I've spoken about before, but all these things come into play. So I do agree with what they're saying here. In Ford Q2 2024 10Q, in item 2 of its MD&A section, that was a mouthful, the company disclosed it entered into agreements to purchase an incremental $3.8 billion of regulatory compliance credits in North America and Europe. Combined with previous balances and current period credits used, we estimate that Ford has a total of $4.4 billion of regulatory credits for use in the current and future model years. We anticipate other car companies such as GM and TSLA may be wading more deeply into the ZEV market as buyers in the quarters ahead. We estimate that Tesla may account for as much as half of the credit sales in the market. That's substantial, supporting a 100% margin business for Tesla that may not be anticipated by the investment community at this time. Yes, exactly. And I think as well, expanding on this, there's going to be lots of areas of Tesla, whether that's happening now or in the future, that aren't the primary source of income, aren't the primary source of profit and revenue, but are still substantial. We think about services and other, we think about eventually lithium, the lithium refinery, they are going to become vertically integrated, and in the end, they could be an actual player in that industry. Who knows? There are many things that Tesla's working on that aren't going to be the main thing, but will definitely add revenue to their business. The next one is managing exposure to China risks. Tesla's China-sourced revenues accounted for 18.2% of total Tesla revenues in Q2 2024. While this line may exhibit seasonal volatility, yes, as with anything automotive does, not just automotive in China, the automotive industry in general is very, very dependent on seasonality and cyclicality. It's important to remember. Volatility in the quarters ahead, we expect the long-term trend for Tesla's China exposure to continue to fall systemically. By 2030, we forecast that China accounts for approximately 10% of Tesla auto unit volume and between 6 to 7% of the total group revenue. So Morgan Stanley are thinking that Tesla is going to become less and less dependent on China as time goes on. I think China is a very, very important market, and I think it will be a very important market for robotics and autonomous vehicles as well. And I think that Tesla is positioned perfectly to capitalize on this opportunity. Increased contribution from recurring services revenue. Services and other revenue accounted for 10.2% of the total company revenue in Q2 2024 and 9.7% of sales on a trailing LTM basis. It's notable that the services and other revenues increased 21% year over year, while automotive revenues decreased during the same period. Now, I've spoken about this before, but if you look at services and other plus energy, if you combine those two revenues as a proportion of Tesla's total revenue coming in, it's been shifting dramatically. So this time last year, those two things accounted for about 14% of the total revenue. This time, 22%. Now, obviously, they're looking at just services and other, and I'm talking about services and other plus energy. But you can see that other areas other than the automotive business are quickly becoming more and more significant. So when people say, okay, well, you're wishing that FSD, Robotaxi, and Optimus are going to happen, but right here and now, all we're seeing is money from the automotive segment. Therefore, Tesla is overvalued. It's not worth it, and you're just praying for something to happen that may not. Actually, I'd push back on that and say, look at the data. We are already seeing the shift happen. Yes, at the moment it's in services and other and energy, but quickly, these things that we've been saying are coming true. Tesla is becoming less and less reliant on selling vehicles. We know that these services revenues should largely grow in line with the growth of Tesla's installed car population, which we forecast to rise to 24 million units by 2030, a 24% compound annual growth rate from 2024 through 2030. So they're still seeing growth in the automotive segment, let alone the other areas. We also note that the margins derived from after sales and services of the car fleet are typically far higher than the point of sale margins. Next one, strong position in the fast growing energy storage portfolio. This is not to be underestimated. From our discussions, investors are starting to consider the potential for Tesla to be an expression on the AI theme, but recent indicators of climate change are bringing even greater attention to Tesla's dominant position in the energy storage. Severe storms and unusual global weather phenomena, including heat waves, may be focusing investors' attention on companies that may be well positioned to address climate change and energy-related problems. We see the potential for the Tesla's energy business to be worth more than the auto business. I completely agree. Investors are focusing on the theme of generative AI acceleration, spurring a multi-generational increase in energy demand and a recent 2x beat in the Q2 Tesla energy storage deployments, with gross margins roughly twice that of the auto business. This is the point. Megapacks are in high demand. The revenue in the energy segment is growing and the margins are looking very strong. The next one is optionality on new expressions in AI and autonomy. As we continue our analysis of the overlap of AI and robotics, it is increasingly clear to us that the commercial opportunity of the non-auto expressions of embodied AI is likely to far larger and faster adopting than that of autonomous cars. Yeah, the total addressable market is going to be way huger, etc., etc. We believe that the humanoids opportunity is far bigger and faster adopting than autonomous cars, and we'll see a greater quantum of capital behind it. Tesla is at the epicenter of this theme. Investors may need to add new tabs to their Excel models. And then we've got risk considerations. We believe near-term expectations around FSD and robotaxi may be too high. Okay, let's see why that is. We were not terribly surprised to see the original 8th of the 8th robotaxi day be postponed, and would not be shocked to see the content of the 10th of the 10th event to include commercial themes far beyond just autonomous cars. In our opinion, the biggest tell as to the governor of AV commercialization at scale is the lack of the third-party statistically and empirically tested safety data from the likes of these organizations or other respected industry and regulatory bodies. We need something far beyond intervention data and suspect the absence of such a study may reflect that the system does not, at this point, clearly demonstrate beyond doubt the efficiency of the system versus human driving statistics. Autonomous cars are tasked with avoiding objects. There are other use cases where it may be easier to target objects. Personally, I don't really see that as a risk consideration. I used to see it as a risk consideration, but after looking more and more deeply into ARK Invest's research into this, I don't think it's going to be that much of an issue. I think Tesla, without a doubt, will be able to prove with their massive amount of data that they've already got that autonomous driving, Teslas using FSD software are far safer than Teslas not using it, and then all the other vehicles out there that aren't Teslas. So I don't think it'll be too much of a problem. But let's carry on. The next one. Specifically, we believe expectations around Tesla's ability to, and then let's have a look, commercialize autonomous technology in China are too high. Interesting, okay. We recently asked the question, what is Tesla's future in China? In our opinion, if Tesla or any other US company were to solve the robotaxi problem, we believe it would be highly unlikely that the company would be allowed to offer such technology within the PRC. The dual purpose element of embodied AI carries obvious national security sensitivities. I do see where they're coming from on this one, and I do think that if China are able to solve it themselves, they would rather do so than rely on an American company. But we'll have to see how this plays out. Do let me know your thoughts on that though. If you think this is an actual risk consideration, or you very, very much think that Tesla will have a robotaxi fleet all around the world as the leader. That you don't really believe that this is a risk as such. EV winter may be prolonged and could still require further steps to mitigate further potential losses. We recently reduced our fiscal year 2030 US EV penetration forecast to a street outlier low of 20% versus 25% previously, driven by a number of factors ranging from sluggish demand, regulatory uncertainty, and economic factors. Like I keep saying, EVs, the automotive industry, is very cyclical. And then other governance considerations. Elon still does not have 25% block-in minority of Tesla. Tesla's CEO has expressed clearly his desire to achieve 25% block-in minority vote position in Tesla. This is about Elon's voting power. To ensure, in his view, that powerful and potentially dangerous AI technology does not fall into the wrong hands. I think it's very, very important. We've spoken about this before. However, on our calculations, assuming the 2018 CEO compensation package would only take Elon Musk's stake in Tesla to just over 20% before taxes, how would the extra $40 billion to $50 billion gap in voting stake to bridge that 25% be achieved? So that's what Morgan Stanley had to say. But we've also had Piper Sandler come out and speak about Tesla too. So let's now see what they have to say. And this one is much, much shorter. Piper Sandler analysts have issued a bullish note on Tesla, suggesting that the company may have finally cracked the code for full self-driving technology. The note emphasizes the significance of the latest FSD update version 12.5, which has garnered positive user reviews on the X platform. Despite Tesla's history of overpromising on FSD, analysts believe that this time may be different. Yeah, go and look for yourself. You can see people that have used 12.5, that have documented it, that have spoken about it. Very, very positive things to say. It seems to be a big shift and they're coming in thick and fast, these updates. I think we're getting close. Tesla may have solved the self-driving puzzle. Don't roll your eyes. Buy Tesla, the note is titled. The analysts highlight the upcoming robotaxi event on October the 10th, viewing it not as a distraction from falling EV sales, but as a pivotal moment for Tesla. We think investors should consider the possibility that Tesla's decision to host a robotaxi event isn't a ploy to distract from falling EV sales, they state. The analysts believe the focus on FSD at this event could underscore its importance to Tesla's future. Interestingly, the note points out that investors are eager to learn about the non-FSD updates, particularly new product launches. Yes, because Elon came out and said that they're delaying it because it allows us to something show other things. Nothing was really said, but what could those other things be? Maybe new product launches for sure. Tesla has hinted at unveiling a more affordable vehicle priced between $25,000 and $30,000. However, Piper Sandler analysts assert that the primary significance of such a vehicle would be as a platform for disseminating FSD software more widely. Yeah, it all ties in together, right? None of these things stand alone. They all very much feed into the bigger picture where Tesla's trying to get into the Tesla ecosystem, all of these things. It makes complete sense. The roadmap is there. We're just moving on the roadmap now. According to the analysts, if investors hold Tesla at its current valuation, they must implicitly believe in the transformative potential of FSD. The firm's discounted cash flow analysis suggests that without FSD revenue, Tesla's fair value would plummet to only $77 per share. They project FSD take rates will surge sharply around 2030, ultimately achieving near total adoption across Tesla's fleet. Additionally, they foresee FSD subscription prices increasing from the current $99 per month to over $500. In conclusion, Piper Sandler recommends buying Tesla, emphasizing that the pivotal role of FSD in the company's valuation and future growth prospects. I actually had a whole conversation with a guy named Amir recently, and I'll link the video on the screen now. And during that conversation, we spoke about his valuation model for Tesla. And I asked the question of, how do you effectively and accurately value Tesla when we've got all these things coming up that are unknown? We don't know the revenues that are going to come in from Optimus and FSD and a robotaxi fleet. They are also markets that have never been tapped into, so it's really hard to compare them to other competitors. If you're interested in that, do watch the conversation. And lastly, Elon Musk has confirmed that FSD will be rolling out to Cybertrucks come mid-August. Again, we've spoken about this in recent episodes, but at some point soon, we are going to be seeing these massive, high utility, completely futuristic looking vehicles driving themselves. To me, that is crazy, but I'm excited to see and hear more about this and follow, what the celebrities that have the Cybertrucks are thinking about full self-driving, because that is going to be a really, really smart way to get FSD knowledge out to the mass public. Because in our community, we feel like everyone must know that Tesla's working on autonomous driving, but actually go and ask someone on the street what Tesla does, they won't even know that. They'll only know that Tesla sells EVs. They won't even know about the energy business, about Optimus, none of these things. So if celebrities that are posting about their Cybertruck have access to full self-driving technology and they can showcase their car driving themselves, which they absolutely will, it's going to wake a lot of people up as to what is really happening. With that said, thank you so much for watching this episode. Please leave your thoughts in the comments below and I'll see you in tomorrow's episode.